Good afternoon. We are the Pioneer Investments, and it's our honor to present our analysis for Consumption Industrial Corporation. With over 50 years of industry presence, Consumption Industrial Corporation has established itself as the home of the Philippines' most trusted brands, carrier for air conditioning, and Condura for refrigeration. It is strongly supported by a wide distribution network, allowing its products to be available at over 90% of retail stores nationwide. CIC mainly operates in the air conditioning and refrigeration business with its two subsidiaries, CCAC and CBI. Recently, it entered into new businesses by joining forces with two huge companies, Midea, a global white goods manufacturer, and Otis, a top player in the people-moving technologies market. Using a discounted free cash flow method, with a cost of equity of 9.7%, we realized a one-year target price of 66 pesos and 44 centavos, offering a 62% upside from its closing price on November 28, 2014. Later on, we'll present how CIC's leadership in the underpenetrated market, growth opportunities through M&As, and cost savings through synergies led to our strong buy recommendation.
Though this one of Asia's fastest growing countries, the Philippines achieved a 7.2% GDP growth in 2013, higher than the 5.8% regional peer average. With a sustained economic growth, the real estate sector is foreseen to flourish as 420,000 square meters of office supply is foreseen to flourish as 420,000 square meters of office supply is estimated to be delivered yearly for the next 5 years, while an average of 9,000 units will be delivered for the next 3 years. Along with the rising Philippine economy, the underpenetrated market for air conditioners and refrigerators signifies a bright outlook in the industry. Compared to its ASEAN peers, penetration rates in the Philippines are considerably low, as only 6% and 35% of Filipino households have air conditioners and refrigerators respectively. This translates to the strong growth potential of the industry, considering the closeness of their average maximum temperatures. Demand is expected to be spurred by the Philippines' increasing minimum and maximum temperatures and the growing preference for inverter models due to high electricity rates. Now, the Philippine air conditioning and refrigeration market is being led by these companies. With a share of 37% and 26%, CIC stands as the prime leader in both markets. It is expected to remain strong amidst competition as it holds well-established brands which cater to various income groups. As a member of the Philippine Green Building Council, CIC also integrates energy efficiency to its products as proven by the relatively high energy efficiency per peso of its units. With this, we forecasted yearly core businesses sales to grow by 3%, while the value of CIC's core businesses was computed using the discounted free cash flow to equity method, arriving at 54 pesos and 20 centavos. As the prime leader in the underpenetrated air conditioning and refrigeration market, CIC is well positioned to capitalize on the growth opportunities in the industry, thus solidifying our buy recommendation.
While CIC's core businesses are financially rewarding, the impact of its new businesses cannot be neglected. Through Concepcion Midea, CIC expands its offerings with the introduction of Midea's products in the Philippines. This enabled the company to gain access to a 27 billion peso market in the new appliance categories. Moreover, this would allow the company to capitalize on the expected 23% industry growth by 2018 through the creation of new revenue streams. On the other hand, the company's move towards a consumer-based business solutions segment CIC entered into the production of elevators and escalators by acquiring OTs. New businesses. Based on forecasted cash flows of each business. These were discounted using our cost of equity, arriving at an equity value of 9 pesos and 52 centavos. These new businesses will be complemented by synergies from logistics and shared administrative expenses. With the untapped market potential in its core business and synergistic opportunities in its new businesses, CIC is geared up to maximize the growth opportunities in the industry. To support our buy rating, we conducted a comparison of CIC's price-to-earnings ratio against small-cap stocks under the Philippine Stock Exchange. This revealed that CIC is trading at a discount when compared to the consumer sector, therefore strengthening our bullish outlook.
Over the years, CIC has exhibited solid financials due to its ability to generate strong revenue streams along with effective cost management and under-leveraged operations. We analyzed CIC's financials by breaking down its ROE through DuPont analysis. Consistent and positive net profit margin is exhibited in 2014 to 2018 as a result of its cost reduction measures. The company posted an operating expense per sales of 16.68%, lower than the peer group average of 20.88%. Its total asset turnover is expected to decrease mainly due to its ability to generate strong cash flows, leading to excess cash balance. We expect the company to be very liquid as we project its cash ratio to be above 1.0 in 2016 and beyond. We assumed its financial leverage to be very low as it managed to retain its debt level to virtually zero. This gives the company sufficient allowance for its future liquidity needs. However, its ROE is expected to decrease mainly due to its excess cash balance and under-leveraged operations. Nevertheless, retaining most of its earnings could lead to a better liquidity position in the succeeding years, thus strengthening its financial flexibility. This will then be essential in the broadening of its product scope in the following building management products. With its cost efficiency and under-leveraged operations, CIC's financial flexibility makes it capable to pursue M&As that would support its platform of being a one-stop business solution shop, thus reinforcing our buy recommendation for CIC.
We've also conducted an analysis on CIC's key investment risk, measuring each likelihood and impact, and also analyzed how the company mitigates the effects of this risk. Among all the risks, competition poses the biggest threat due to the presence of prominent international brands. With CIC's leading market position, backed by a strong distribution network, multiple brand offerings, and Philippine-focused innovations, the company is able to keep its foothold in the industry. Considering the impact of competition, a very conservative assumption of 3% price and quantity growth for the next 5 years was used to get our target price. All else the same, both price and quantity growth would have to decline to 0.55% in order for us to change our recommendation into a hold. We need to drop further to a negative 0.35% for a sell rating. To end, we have arrived at a 1-year target price of 66 pesos and 44 centavos. From CIC's leadership in the under-penetrated market, growth opportunities through M&As, and cost savings through synergies. With CIC's attractive valuation offering a 62% upside, solid financials, and resiliency to risk, we recommend a strong buy rating as CIC builds a legacy of comfort. Thank you, and we are now ready for your questions.
By far, your target price for CIC is significantly higher than all your peers. What are you seeing that the market isn't seeing? And on a PE basis, what PE does a 66 peso target price imply, and how do you justify that?
We assumed high upside for the company because we believe that there is something in the company that the public has not fully realized yet, and that is the strategy behind its mergers and acquisition. We believe that there is, or rather, the company has a pattern that it is following its mergers and acquisitions. So, based on our observation, we believe that the company is basing its mergers and acquisition with that of the platform of the United Technologies Corporation. United Technologies Corporation is a US-based company which owns Carrier and Otis. And we believe that the company follows the platform of UTC's business solution segment. And we arrived at this conclusion because the company holds two brands of that conglomerate, and it also formed a joint venture with Medea